Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So on today's Monday mortgage market update, I want to talk a little bit about last week. There's been some news today that has moved the needle in a good way. And then the big thing that's going to really, I think, influence mortgage rates this week on Wednesday, the Fed dot plot specifically. So last week was similar to the week before, where there was a lot of kind of up and down movement. The thing that was interesting is the two biggest reports of the week, CPI and PPI, both measuring inflation. The headline and the core numbers came in below expectations, which typically would lead to improvement in mortgage rates. However, in both cases, the market either reacted negatively, mortgage rates went up, or kind of was a wash. And the reason for that is the components of both that trickle into PCE, the Fed's preferred method of inflation that comes in at the end of the month, were higher than the previous month. So it's an interesting, and then we had some of the same things that have been happening where on Thursday we had this kind of random improvement in mortgage rates that was not really, that wasn't preceded by any economic news or data, but it was Scott Bessent, Treasury Secretary, making some comments that the market reacted positively to, kind of the opposite to the week prior with Jerome Powell's comments on Friday. So the market is still very volatile in general and is really latching on to things that they normally wouldn't, as we still are in kind of this uncertain economic landscape with what's going to happen with tariffs and whatnot. Now, today, we've seen some improvement in mortgage rates, and it's been driven, I think, by two things. One is retail sales, which is another inflationary metric that came in lower than expected for the main number, and then for their version of core retail sales, which excludes auto, it came in as expected. The other thing that I think has helped with mortgage rates is the Empire State Manufacturing Survey, which is, again, one of these reports that typically you wouldn't really care that much about, but it came in way lower than expected. So that's another one of these little indicators that maybe we could be heading into a recession. And lately, the market has been really latching onto those more than it would normally. Certainly, we could have comments from Scott Bessent, comments by him. We've seen where Trump, if he's more pessimistic and suggesting maybe a recession is coming, that has been latched onto by the market a little bit. But generally, Scott Bessent is the guy who kind of whatever he says is going to cause some reaction. But as far as things that are scheduled this week that will for sure have some sort of impact, the big thing after today is Wednesday with the Fed rate decision. Now, the Fed it's been expected for probably 2 months now that the Fed is going to pause rates at this meeting. So that in and of itself is not going to make an impact. But what absolutely will make an impact is the Fed dot plot, which is the Fed's quarterly projections on things like inflation, things like GDP, key economic metrics, and what the Fed expects to happen with their rate cuts in the future, the rest of this year and several years into the future. Now, at the last meeting, which was in December, where they released their dot plot, the consensus was an expectation of 2 rate cuts in 2025. That was down from in September, they were expecting 4 rate cuts. And before that, it was lower. So this changes pretty much every meeting. Now, the things I always like to look at when we're heading into a new Fed dot plot is what was the last projections for unemployment rate and inflation and then compare that to what we've seen the last few months since that release. And in the case of this upcoming dot plot, we had an unemployment projected at 4.3%, and that was for the end of 2025. These are all end of year projections. And then we had both core and headline PCE expected to be 2.5%. So most recently, we saw unemployment tick up to 4.1%, and we saw headline PCE already at 2.5, core at 2.6. So from that standpoint, you would think we're kind of on line to meet those projections. You figure a little bit of an uptick in unemployment and inflation should continue coming down. However, what I'm going to be curious about is whether the fear of tariffs driving up inflation changes the math for them. And if that's the case, I could see them lowering their projected rate cuts to 1 or 0 even. And it's worth mentioning that right now, even though there's been a little bit of pullback, especially after Powell's comments, the market is still expecting at least 2 rate cuts in 2025. And the most likely outcome right now is 3 rate cuts. So if the Fed comes in and says, we're actually thinking maybe 1 rate cut, maybe none, that's definitely going to have a negative effect on mortgage rates. And then, as always, Jerome Powell's comments after the meeting will definitely have an impact. However, I really can't see it reversing whatever comes out of the dot plot. If, the dot plot is, again, showing 0 or 1 rate cut in 2025, I don't think there's going to be anything he can say in his press conference that's going to reverse that effect and make things good for mortgage rates, and vice versa. If they're keeping it at 2 or even raising it to 3 rate cuts, which I kind of doubt, but I don't think anything he's going to say is going to hurt mortgage rates dramatically. But as always, if you have any questions, I'm sure there's going to be something that comes out from that day, Wednesday, that's going to be significant, and I'll probably shoot a video reacting to that. But as always, if you have any questions or comments, shoot them below, or feel free to call, text, or email me anytime. But thanks for tuning in to this one, and I'll see you next time.